Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just an hour to go now until the closing bell, and stocks are higher here as Wall Street looks to recover from steep losses on Monday amid AI disruption fears. Our very own Jared Blickery is standing by with all the headlines. Jared.
Thank you, Josh. What a difference a day makes. And let's go through the price action here. A lot of yesterday's losers are today's winners. And here's the Dow. You can see we're pretty close to the highs of the day, up about 400 points or 0.8%. Meanwhile, here's the Nasdaq Composite, similar chart, but up a bit more, 1%. And the S&P 500, just a step down, still looking pretty positive there, up 0.75%. And finally, the Russell 2000, small caps, looking pretty good there too, up 1.25%. So the small caps, small is leading. I'll show you the micro caps as well. They're up even more, 1.5%. So that's kind of the story of the day. There's a lot of risk on flavor, and we'll take a look at that through some of the heat maps in a second. First of all, here's the 10-year T-note yield. That is up 1 basis point to 4.04%. That's after a pretty steep drop yesterday. And here's the 30-year. That's going down the opposite direction, but just a tiny little bit, down to 4.69%. And I do like to check on the US dollar index. That is up just slightly. Now here's the large cap sector action. I said what was doing poorly today is doing well today, and in fact, it's leading. That would be consumer discretionary, up 1 2/3%. Second place is tech. Then you got industrials. All three of those outperforming and also up more than 1%. Utilities up almost 1%, and then materials, that's outperforming the S&P as well. To the downside, we got energy and healthcare in the red today. Financials have bounced back, but some of those big banks have been having some problems this year, so we'll take a look at that in a second. Nasdaq 100, we got Amazon up 2%. So is Tesla, in fact, a little bit more. Meanwhile, Broadcom's down 2%, but I want to save this view for a little look into the industries that are shaping that map. Here's software. You can see Oracle up 3, Adobe up 3, Salesforce up 3.5. A lot of these AI fears that we've had have been erased, and that's because Claude is now saying, well, Anthropic is saying that Claude is going to partner with a lot of these software companies instead of steal their lunch. Here's Thomson Reuters up about 10%. I want to get to two boards here. Here are meme stocks. All you got to see is that we are broadly positive in most of these names. That's just a barometer of risk taking. But then I did want to show you one sector that was just trading a little bit to the downside overall, especially this morning. Not everything, but here are the big banks. This is one of the worst sectors of the year. You can see Bank of America down 1%, Wells Fargo down 0.8%. Meanwhile, Goldman Sachs up 1%, and Capital One Finance, that is up nearly 4%, Josh.
All right, thank you, Jared. Well, Meta is going all in on AI, striking a massive multi-year deal with AMD. Meanwhile, Anthropic is turning up the heat on traditional software companies. And AI isn't just disrupting tech, it's also sparking a standoff in D.C. Defense Secretary Pete Hegseth is calling Anthropic's CEO to the Pentagon in what's being described as a not-so-friendly meeting over military use of AI. To unpack all the headlines, we're calling in for tech support with Yahoo Finance's Dan Howley. Dan, it is great to see you. Let's start here with that Meta and AMD news announcing this 6 gigawatt GPU deal. How big is this deal, Dan? Frame it for us. And why is 6 gigawatts matter so much? And what does that even mean, Dan, in practical terms?
Yeah, I mean, it is wild that companies continue to announce these deals in gigawatts. Just tell us how many GPUs you're selling. That's, important for anybody that's following the industry. 6 gigawatts, that could power millions of homes, basically. It's a massive deal. It's a multi-generational, multi-year deal where AMD will provide chips to Meta in its new Helios rack scale system. So you see NVIDIA, they usually have those racks that they show off at their events. AMD is rolling this out. It's its first huge rack scale solution that they're going to be offering. And Lisa Su has said, it's the best rack scale solution in the world, taking kind of like a swipe at NVIDIA, but we'll have to see how that plays out. But it's an absolutely massive deal. It comes just after Meta had announced a similar deal with NVIDIA last week. So clearly they're diversifying. They're ensuring that they aren't, being held to just one vendor when it comes to the GPUs. And for AMD, it's a coup, right? Because they're selling presumably millions and millions of GPUs. And at the same time, we get into this conversation of these circular deals, because just as they're selling these GPUs, then Meta's taking potentially shares of AMD as part of different tranches based on different performance levels. So once they deliver the first gigawatt of chips, then Meta would buy the first tranche, and so on and so on and so forth. So it kind of raises that specter of the circular deal again, as well as the overall build out of AI.
I'm also reading reports, Dan, while we have you, about how Anthropic hosted its Enterprise Agents event, talked about new partnerships, and it sounds like software investors breathing some kind of sigh of relief today. I see some names in the green. The IGV, the software sector ETF, that's in the green. But of course, that sector has been clobbered. Dan, how are you thinking through this?
Yeah, the clobbered isn't even close to the term I would use. Pile driven. We'll go with that. They've been just destroyed because of basically speculation that when Anthropic announced its Claude Cowork and then plugins for its Claude Cowork, which allow Cowork, which is essentially an AI agent, to perform certain enterprise tasks like legal or research, things like that, well, okay, you just throw the baby out with the bathwater now, because we don't need these software as a service companies. We don't need ServiceNow. We don't need CRM companies like Salesforce. And so that was basically the going fear. And so those got just decimated last week. Now, this week, Anthropic announces that they're going to be working with some of these companies when it comes to rolling out their new features, which include plugins. They'll work directly with things like Gmail or with Excel. They said that they have different deals that are going on that'll feed these plugins and this capability customizations. And so now we're starting to see investors say, oh, well, maybe it's not the end of the world. Maybe we, tad bit overreacted there for a minute. And, I spoke to some analysts last week who said, look, this is kind of a wild just overreaction, because these are dedicated companies, these software companies, to a specific area, right? And so it's not as though these general AI companies are going to be able to immediately replicate exactly what they do and then provide the same kind of services they do. They'll eventually just kind of work the AI into the product. And that seems to be exactly what's happening now.
Yeah, it's interesting, Dan, just on these AI disruption fears in software, just to see how big tech CEOs are weighing in. And you've talked about this and written about this. You have Nvidia CEO Jensen Huang saying the idea that AI replaces software, it's illogical. ARM CEO described the sell-off as micro hysteria. Are they right, Dan? I mean, do you look ahead and say, yes, AI ultimately will be it'll be a software enabler? Or do you think, when you hear tech CEOs like that, are they in part just talking their book?
I think it's 6 to 1, half dozen the other, right? Because they are doing that, yes, but I do think that they are accurate in that there's not necessarily going to be, an AI company that can come in and just roll over every software company out there, right? I mean, you look at something like a Microsoft, which is an AI provider, an AI company, as well as a software company, and it's taken them decades to get to the level where they're able to do something like that. Now, OpenAI, Anthropic, they're advancing rapidly when it comes to AI, but when it comes to the actual software side of things, well, that's not exactly where they're playing. And so it doesn't make sense really to think, okay, we have these cool AI models. Look what they've been able to do with search. Look what they've been able to do with chatbots, the integrations. It just leads you to think then, well, of course, that software is going to go the way of the dinosaur. That's not exactly the way it's going to be. The way I think about it, personally, is that it's more of a tool that you would use within these apps or alongside these apps. So, we had Word and PowerPoint before we were using the internet, and they didn't go away. They adapted over time. We not have those old encyclopedia, pieces of software that were installed on Windows 95 or whatever that you would read because it took forever to get online. But, we still have those capabilities. And so I think it's going to stay that way where, we have these software companies, we have the software tools, and then we're just adding AI into it to improve them over time. And I think that's really the more logical direction rather than thinking, all right, well, pull the fire alarm, everybody evacuate, software is done.
Finally, Dan, since we're talking Anthropic, Axios reporting that Defense Secretary Pete Hegseth, he summoned Anthropic CEO Dario Amodei to the Pentagon. It sounds, Dan, like we have some tensions here between these two. What do you make of it?
Yeah, I mean, look, this is an interesting development, just in that, Anthropic's been very outspoken. Dario Amati's been very outspoken himself about needing certain guardrails around AI. He's previously said that providing high-powered AI chips to China is like giving them a nuclear weapon, more or less. And so, there's this back and forth tug now where they want to work with the U.S. military, with the Pentagon, but the Pentagon saying, hey, then we have to be able to do what we want with this AI. And Anthropic basically saying, no, we don't want you to be able to, make kind of autonomous weapons or things like that, or do mass surveillance of Americans. There's certain red lines that we don't want to abide by. And the Pentagon saying, well, if you don't let us do that, then we'll cut you off and say that you're a supply chain risk, which could put other companies in jeopardy that rely on Anthropic, or we can just kind of force you to if we want to. And so, there's this high tension. It doesn't sound as though this meeting, this is according to Axios, went exactly well. Doesn't sound like it was very, warm and fuzzy, and there was some tension. It remains to be seen what's going to happen here, because Anthropic kind of set itself up as this company that's based around guardrails and about AI safety more than anything. And enterprise as well. The government is a huge customer that they can ill afford to upset or leave by the wayside. So they'll will likely come some negotiation where they work things out. I mean, that's usually how things like this work. But if worse comes to worse, it could be bad news for Anthropic.
As you're talking, Dan, I'm wondering, one way to solve this, you got Pete Hegseth, big fitness guy, very into feats of strength. I think I just saw him put up 315 on the bench. I think that was on video. You challenge Dario Amodei to a push-up contest.
You do that.
What do you think?
Both of them blue jeans only. You got to go, the RFK route,
yeah.
right?
Well, that goes without saying. Sure.
It's the ultimate workout gear, I guess. I would love to see who could win. I'll put myself in there. I can get,
why not
50 in. Then I'll need, probably some string cheese to revitalize myself, and then probably take a nap for an hour and a half.
The money would be on Hegseth, but I'll just say, you can be sneaky strong. Like you can be sneaky tall. You never know.
Dark horse.
Yeah. Thank you, Dan. Appreciate it. Thank you, sir. As investors digest Meta's expanding partnerships with chip companies, it puts into focus the increasing CapEx spend that big tech is investing into their AI infrastructure. Wall Street eagerly awaits to see the winners and losers of this trade, and so has my next guest, Thomas Carroll, Stifel Equity Strategist. He says the AI trade is splitting off into hardware winners and service losers. Thomas, it is good to see you. So let's just start there. You say we're seeing this split now between, as you put it, AI hardware winners and AI service losers. Explain that for us, Thomas. Walk us through it.
Yes. Thank you for having me on. Yes, the crux of this note was, if we think over the market over the past 3 years, it's really been about, going along the entire AI trade, right? But what's been interesting to us over the past, really last quarter has been, as you said, the splintering of AI services, which are the perceived losers, which you and your previous guests were just talking about, and the perceived winners, the AI hardware names, which are, have a perceived safety attached to them, and the market has really moved into them. But the idea of this note was that we really, questioned the overall safety if we were to believe the market's opinion on the overall losers of the AI services trade. And so if I were to take you into what we're really seeing in the AI services space, as you talked about your previous guest, there is significant pressure on these business models as we move forward. And it's very easy to see across the credit curves. We're seeing, a significant move higher in credit risk premiums, whether it be for very safe names, or even to the high yield space and the tech space as well. And that's what's really, in our opinion, that's driving down a lot of these AI services names. Fears on the extended amounts of CapEx they're doing with the uncertain ROICs on the back half of this CapEx. The question we have is, if we were to believe the market that it is existential for these AI services companies, well, if you look at the primary revenues of the AI hardware names, it is the capital expenditure from the AI services names. So there's an interlinkage between the two, and the splintering of this trade has us somewhat cautious, which fits with our overall S&P 500 view coming into this year.
Thomas, you actually compare here this moment to the late 1990s, which is interesting, when hardware and services diverged sharply, and then we saw volatility explode there. What are the sort of the most important similarities between now and then, do you think?
Yes, I would say that particular study got a little bit of the goosebumps up on the back of my neck when we first observed it. If we think back into the late 90s, right, we just remember the tech bubble, the boom and the bust, but it actually was obviously a very long period. And the Nasdaq actually peaked in the beginning of 1999, but the market held on for roughly 9 months. And so what we observed then, which is very similar to what we're observing now, except the GPT at the time then was the internet, which obviously we are talking to the internet. It has changed all of our lives. You do not doubt the importance of AI, but it was very interesting that hardware took off in an exponential pattern relative to internet services at that time. And when that trade did peak, it went up 95% in a 9-month period. And when it did peak, it was kind of the top for the market at the time. And so we are observing, a GPT similar to, maybe potentially even bigger than the internet. We're seeing a very similar splintering of, services relative to hardware. The similarities kind of have the goosebumps back up on our necks a little bit as we observe it, especially given how thin the margins are for the overall S&P 500 entering into this year.
I did think it was interesting, Thomas. You note here our AI services, you say, trading at relative valuations we haven't seen since, you say, the global financial crisis. I mean, I guess as an investor then, you're trying to decide, okay, at that level, is that an opportunity or it's a value trap? How do you make that call?
Well, I think the question is, why is that occurred, right? Because we continue to see forward earnings go up for these companies, but yet we're talking about a 10-year re-rating of the price to earnings multiple. And that's when I brought up the overall credit risk that we're seeing rising in the system. It's really getting attached to these names. And the question that we have is, okay, if the CapEx is beginning to become existential for these companies' business models and it's dragging down this valuation, it could be a value trap if that is correct, if, the credit stress begins to broaden. I think the bigger question that we're having is that, do we begin to see that broaden out to the general economy, because the overall AI space has been so important to the U.S. economy through the wealth effect of the K-shaped consumer, but also to the industrial production side as well.
You mentioned this earlier, Thomas. I just want to come back to this rising credit stress in parts of the tech sector. What are you seeing exactly, Thomas? What signs, what signals, and how concerned do you think investors should be about that?
Yeah, for us, when we look at the overall AI services space, it could include the biggest hyperscalers, right? They have seen their credit risks rise. Over the Oracle chart that's gone around has been very, seen by a lot of investors, but it's really true for most of the hyperscalers at different frames, but also out to the broader credit risk, the high yield space. We've seen a near doubling since the back half of last year in the overall, what we would call, the high yield credit spread and markets. And that's been a significant driver for the valuation compression that we've seen in the AI services space. And that's kind of that is something that we tend to see during, the initial stages of stress that's being built in the system in regards to really any sector of the economy, but specifically here as to do with tech.
Thomas, great to have you on the show today. Thank you.
Thank you for having me here. I appreciate it.
Coming up, we get a check on the health of the U.S. economy. That's next on Market Domination. Fed officials have been reacting to the Supreme Court striking down of President Trump's global tariffs. Yahoo Finance's Jennifer Schonberger has been looking at the latest Fed commentary. Jen.
Hey there, Josh. That's right. As President Trump looks to replace his tariffs that were struck down by the Supreme Court with new ones, Chicago Fed President Austin Goolsbee says that is ratcheting up uncertainty and likely to perpetuate this no hire, no fire environment we've continued to see in the job market. Goolsbee saying this likely pushes off any renewed hiring we may have seen if rates had been held steady. He thinks the dynamic of the stalling job market is a result of uncertainty, not weakness in the economy. Now, if the new effective tariff rate under the new tariff regime that the president is pursuing ends up resulting in lower overall tariff rates, then that could help bring down inflation. Goolsbee says he is looking at prices of goods which have been pushed up by tariffs for signs that inflation is beginning to fall. Hasn't quite seen that yet at this point. Though Goolsbee says he still thinks that the Fed could cut several more times later this year if inflation does indeed fall. Now, meanwhile, the Cleveland Fed out with a brand new working paper today on how uncertainty on tariffs impacts consumers. The paper, which is still subject to revisions, finds that increases in uncertainty of tariff rates strongly discourages consumers from buying big-ticket items like cars. If there were no uncertainty and expectations for higher tariff rates, then that would encourage consumers to increase spending. The results also show that if there is uncertainty, that leads to consumers putting off purchases. Now, elsewhere, Fed Governor Lisa Cook spoke earlier this morning about AI. She thinks that AI could raise productivity and boost economic growth, though it could push down employment in the short term as jobs are replaced by the new technology of AI. She says that will put policymakers in a predicament of whether to keep rates elevated to rein in inflation or lower rates to support the job market. However, if the job market is being done by AI, there's not much, she says, that the Fed can do with its blunt policy tool of interest rates. Josh?
All right. Thank you, Jen. And don't miss Jennifer's interview with Richmond Fed President Thomas Barkin. That's tomorrow. Continuing the discussion of the Fed now, a majority of traders on Polymarket expect the Fed to cut rates twice this year, but our next guest is still holding on to the possibility of a third cut. Joining me now is Ian Wyatt, Huntington Commercial Bank Director of Economics. Ian, it's good to see you. So let's just start there, Ian. You're still calling here for 3 cuts in 2026. You do say the Fed could pause until there is a new chair, but why is 3 the base case, Ian?
I still think it's a labor force driven. I mean, we see relatively low hiring. Unemployment's ticked up a little bit, but it's not been particularly bad. However, if you talk to parents, if you talk to anyone in their early 20s who's just out of college, it is a tough job market. The Fed's very aware of that. And if we look at historically, when have they moved? What's really gotten them moving? In a couple of those years where they paused and then all of a sudden in September they got cutting, which by the way is what happened the past 2 years. We had a pause from January through basically September, then we got a few cuts. It really was the labor market. We still see a labor market that's soft enough that the Fed's going to feel the need to make a move. And we see somewhat weaker inflation, although inflation dynamics are a little complicated by where the inflation is happening right now for the Fed.
So it's a cool labor market, Ian. Why is it cool?
Few things. One, it's very narrow right now. The hiring is happening really only in healthcare, leisure.
Might have lost Ian, and we're going to try to get him back as soon as we can. By the way, you can check out more from Yahoo Finance's Prediction Markets Hub that's powered by Polymarket by scanning the QR code on your screen. Coming up, we bring you the top trending tickers on Yahoo Finance. Stay tuned for that. We're back with Ian Wyatt, Huntington Commercial Bank Director of Economics. Ian, we saw those technical difficulties, hopefully, so you're back, and that's good news. On inflation, Ian, we were just talking about that. The trajectory of inflation from here, Ian, I want your take there, because you say goods inflation from tariffs, you say, looks like it was more of a one-time shock. You say housing inflation, that's falling. Services ex housing, though, that is still running hot. Why is that, Ian? And what do you see ahead that maybe could bring it lower?
So a big part of that is healthcare. We see it in the healthcare industry being a problem. And that's part of what's driving it. And that's one of the big differences and challenges for the Fed is they always say we're targeting PCE inflation. So when we say CPI versus PCE, what's the biggest difference? CPI, housing's a much bigger component. PCE inflation, healthcare is a much bigger component. In fact, housing's about half the size it is, and healthcare is more than double the size it is in the relative weights. And what that means is right now, PCE is trending at 3%, CPI at 2.5%. I think the Fed's pretty comfortable if inflation were at 2.5%, saying, hey, we're close enough to our 2% target. That can work. 3%, that's really where you're getting, I don't think the Fed wants to be cutting in a 3% inflation environment. But we do see housing coming down. That's really helping the consumer. We think that's helping ease the whole K-shaped dynamic. And it really is, though, there is still a somewhat tight labor market at the lower end. I talk to companies, if you look at the job postings data, if you look in areas like healthcare, manufacturing, even in an area that's not adding jobs like manufacturing, we're still seeing fairly high job posting numbers. So it's still somewhere where it's tough to find the workers.
What about tariffs, Ian? You point out here more than 1/3 of U.S. trade is exempt under USMCA and other agreements. So does that imply, Ian, maybe tariff shock could be more limited than perhaps headlines suggest?
Yeah, I think that's always the key thing to remember on all these tariffs is there's a number of carve-outs and exemptions, and we sort of see this headline number, hey, tariffs on everything. Well, yeah, roughly 1/3 of U.S. trade is covered by USMCA. Some Central American agreements are still in force. There are a number of agreements that cover things specifically like, say, aviation parts, or, I was talking to people in the disability industry, and disability products are also, so like wheelchair minivans, all those products are exempt from tariffs. So we have to look into the details, and it really matters to the specific client. But yes, that headline number somewhat overstates it. It sounds dramatic more than the reality on the ground. But yeah, companies still manage their strategy around this. It does probably help that case for nearshoring in terms of, hey, the Mexico option is still there. Obviously, recent events in Mexico make people a little more leery about that. But we are seeing that as an alternative that a lot of companies have turned to is Latin America.
Well, I want to end here, Ian, before I let you go, because I thought this was interesting. You asked whether our K-shaped economy could be fading. Why, Ian? What are you seeing with relatively lower income households?
So yeah, what we're seeing, there are a few dynamics that help drive this. First of all, it's that fading rent. If we look at rental inflation, we're somewhere between 0% on new units and 2%. So that's what apartment rents are tracking at right now. That's relatively low. We were at really high numbers for a while. So that's coming down. And, what do lower income households generally? They're renter households. That was part of the stress on lower income households. What there was that they were getting raises, but it was getting eaten up by the cost of used cars. We saw the typical amount financed on a used car went up almost $6,000, but from 2019 to 2022. So we had this jump from about $18,000 to $24,000 there. So a huge jump in the amount people are financed for used cars. That's really held steady. So we haven't seen that getting worse. We aren't seeing rents getting worse. And if we look at some of the default data, early default data on credit cards, on autos, those have been trending downward. And if we look at some of the consumer spending data, the New York Fed actually just released a study, I think a couple of days ago, a chart book where the first time they really broke down spending, looking at panel data of households. And we've seen a lot of those households, when you adjust for inflation, their spending was, those lower income households, their spending was negative for a couple of years. But over the last 9 to 12 months, we've seen that really turn positive. And actually, when we look at some of our other real-time spending sources, we're seeing it trending, at a 4% growth rate, 4.5% growth rate. Now that's nominal, of course, but that's on par with what upper income households are doing. So we think we may be getting to the tail end of this. But I still think, if you're a young person just out of college looking for a job, it's a tough job market. So if you have the job and you're in those buckets that have really been stressed, you're feeling a little less stressed, you're spending a little more freely, and we think the worst of that dynamic may be behind us.
Ian, as always, great to have you on the show. Thank you.
Well, thank you for having me. Really appreciate it.
All right, now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma. Join me now for a look at Home Depot, Planet Fitness, Constellation Energy. We'll start here with Home Depot. So that one important metric here, Brooke, as always, comparable sales, that they rose 0.4% in the quarter ended February 1st. That was better than the street had penciled in. EPS ex some items that also beat.
Yeah, and what we're really seeing here is a little bit of optimism among the street, among investors, that this could maybe be a step in the right direction. At least that's what we heard from D.A. Davidson analysts saying in a note that this is a step in the right direction, particularly as mortgage rates start to just inch a little bit lower. Also, this analyst said that should be enough for Home Depot to continue their stock outperformance this year and bring Lowe's, which is reporting tomorrow, up with with it, we also heard from a zoo analyst who said that the environment is stable. And that's something that we've been waiting for quite some time. And they also made some interesting call outs in the call. They said that storm activity, winter storms in January sort of boosted the stock. Also, they continue to see positive comps, positive same-store sales growth for their pro business. And certainly that outperformed DIY customers as well. We're still under a bit of pressure there.
All right, next up, Planet Fitness. Let's look at that one. Sliding, that's despite topping earnings estimates. The adjusted EBITDA outlook pointing to concerns for Wall Street. I think that was it. It was the outlook for 2026 adjusted EBITDA growth. That suggests profit gauge misses estimates. Per Bloomberg, they expect about 10% adjusted EBITDA growth. That would imply a total of about $607 million. The street was closer to about $622 million.
And I think really what the street is looking for here was they were expecting that those Black Card membership prices would increase. Now with this maybe guidance not as strong as they expected, there's some uncertainty around what exactly that could mean there, just in terms of membership costs increasing over the next year. That was a note from William Blair pointing out. But Stifel analysts largely bullish on this, saying that there are several compelling drivers of membership growth in place, including the Black Card price. He says it's still going to increase. They also said the impact of GLP-1 usage, that could be positive momentum for membership growth. And on top of that too, have you heard about the Black Card spa amenities?
Sure haven't. No, tell me
we're
about
talking
it.
Lymphatic drainage, red light therapy, all the things that are trendy right now. Those are some of the things they're saying that could be a potential driver.
You had me at lymphatic drainage.
Ooh.
Finally, a look at Constellation Energy after reporting adjusted operating earnings that came in above estimates. So a couple of things are, yes, adjusted operating earnings per share for the fourth quarter, that beats. Also, in terms of capital return, they did also increase the annual per share dividend, it looks like, by 10%. And they expect to grow the dividend per share by another 10% in 26.
Let's bring this back to what we've been talking about all day, and that is this is AI related, because what we do know is that this is an energy company that certainly is playing into this AI driven momentum. That revenue that we did see reach about $6 billion for the quarter was certainly driven in part by higher power demand tied to those into those data centers that are currently being built out. The CEO saying within the call that Constellation enters this year, 2026, well positioned to meet the nation's growing demand for quote unquote reliable, clean electricity. And so certainly that feeling the benefit of it up about 6% as we make our way towards the close.
Brooke DePalma, thank you. Appreciate it.
Of course.
While financial conditions are generally easing, investors continue to grapple with AI concerns and tariff pivots. Here to comb through it all, we got Rich Bernstein. He is, of course, the CEO of Richard Bernstein Advisors. Rich, always great to see you. So better tone today in the market. I got green on the screen here. Some big themes front and center, Rich. The Trump tariffs, our president defiant, Rich. He's going to pull other levers. He's got other means to employ them. What does it mean, Rich, for the economy, for the markets? I'm sure clients have been asking you about this. What are you telling them?
Well, Josh, great to be with you. I think, I don't think anybody really knows the definitive answer to your question. And I think that has been and continues to be reflected in the price of gold. Gold historically has a very high correlation with uncertainty. Clearly, we're in an extended period of uncertainty here, and gold has been ripping. That's exactly what should be happening relative to history, and it is happening. So I think if one wants to kind of get a grip on what's going on or not going on, or the uncertainty around what's going on, use gold as your divining rod.
Let me ask you, Rich, that's tariffs. Another big theme, of course, is AI. And there was a time we were all focused on the AI opportunity. Now it's AI disruption fears. And listen, you've watched the software space. The IGV has been clobbered. What do you do with that, Rich? What do you do when you go to bed at night, you think you've made a sound investment, you wake up and you hear Anthropic is moving into your space, moving into your vertical, and you get blown up while you were sleeping?
Right. So first of all, I think we have to tone down the commentary a little bit. This isn't the first time we've ever had disruptive technology. That's really the story of capitalism. Capitalism is always based on disruptive technology. And when that technology comes out, it's always life-changing, right? I mean, it's like we've never seen this before. And so I think we have to tone it down a little bit. That being said, this is clearly disruptive technology, but I just think we have to put it in proper historical context. That's number one. Number two is that, yes, I think if you're a low-end service employee, I think if you are a coder, I think some of those jobs are going away, and they're probably going to go away very rapidly. However, that doesn't make up for goods that are not produced in the United States that we still buy. In other words, our trade deficit. When AI can solve our trade deficit, then I think we have something truly meaningful for the U.S. economy. Other than that, it's just a story of the U.S. economy getting poorer because we're not going to make anything else, and prices will go up because we'll make even less. So I think that we've made a big argument for non-U.S. stocks and buying the companies of things that we don't make here in the United States. I think that just gets stronger going forward.
My buddy Josh Brown, Rich, says, I'm very curious to get your take on this. He says the dominant investment theme right now, Rich, is Halo. Heavy asset, low obsolescence, meaning I want to be in names that I think are AI proof. Exxon is Halo. Walmart is Halo. McDonald's, Halo. And I'm just very interested, Rich, what you make of that.
I think that's probably right. I mean, that's kind of been, I know Josh well, and I've discussed this with him many times in the past on his podcast, where we've talked about what I've called the American Industrial Renaissance, where we're looking for small and mid-cap companies that get majority of their sales from here in the United States. You can't do away with those. AI isn't going to solve that problem, right? I mean, and even to make it a little tongue-in-cheek here, if it can, we're going to have to import the robots for that to happen because we don't make the robots here in the United States. So I think this is, my argument has been for the past decade that the American Industrial Renaissance was not very sexy, but a very necessary investment theme, and that other investment themes would come and go, but this was going to be in the backdrop for more than a decade. So far, kind of knock on wood, that's been correct.
Finally, Rich, let me get your take on Bitcoin, because we're back here at 64,000. I was once talking, Rich, on this program to Mike Novogratz, and I asked Novogratz, I said, hey, is Bitcoin one day, is it going to be as big as the gold market? Yes, Mike says. Yes, Novogratz says. So confident, Rich. If I remember correctly, I don't think he even let me finish the question before he said yes. What do you say?
So anybody who follows us as a firm or invests with us as a firm can pretty much guess what I'm going to say here. That Bitcoin is not digital gold. I think we should put that story to rest. And the reason I say that is that gold is a defensive asset that has a high correlation to uncertainty. Bitcoin is a very aggressive asset that has a high correlation to liquidity. They're completely different ends of the spectrum here. They are not one and the same. And so, if you want an aggressive asset, well, that's fine. That's not my firm. That's not me personally. But if you want an aggressive asset, go play Bitcoin. If you want something that's going to be defensive and diversifying relative to a lot of other asset classes, I think you probably want gold.
Rich, as always, we're lucky to have you on the show. Thank you.
Great to be with you, Josh. Thank you.
Coming up, we get an analyst take on Home Depot's earnings. That's next on Market Domination. Home Depot shares, they're higher after posting better than expected same-store sales growth in its fourth quarter. Julie Hyman spoke to Citi analyst Steven Zacconi about those results.
It's more of the same, right? The underlying demand trends for the business have been stable, but we're still waiting for that housing market to kind of unfreeze, right? Like the core thing we'd love to see would be housing turnover improve, right? Like mortgage rates coming down, existing home sales starting to inflect. That would be a big driver of large project activity. We just haven't seen that thus far, but I'd say overall, stable would be kind of the demand outlook.
What would change that, right? Because, we've already seen mortgage rates come down a little bit, but in your view, is there a number at which things start to more dramatically improve, or is there something else that needs to happen before that can improve?
Yeah, we've done a lot of work on the team. I'd say, seeing a mortgage rate that gets below probably 5.5 would be a nice level psychological. We still have 50% of homes that are locked in below a 4% mortgage rate. So you get below a 5.5% level, that probably sees some improvement this year. Then you're starting to think about a bigger recovery back in 27 and 28, right? Because the opportunity here at Home Depot is a multi-year sort of recovery. The last couple of years have been challenged. The give back from the pandemic, obviously everything going on with rates. You'd like to see this year be a year of gradual improvement, is kind of how we've coined it. And then you start to see the next couple of years see an inflection in demand. So I think the trend line is gradual improvement with mortgage rates coming down. I think the last thing I'd say, consumer uncertainty out there has been difficult, right? Like 25, we had tariffs. Now we have tariffs coming off, but maybe we have more tariffs coming on. We'd love to see a little bit more certainty for the consumer so they can spend on some of these big ticket activities and spend back on the home.
You mentioned tariffs, so I'm curious what do we know about what effect the new tariffs are going to have on Home Depot?
Yeah, Depot took pricing in the back half of 25. That probably continues in 26. We just got off the call an hour ago, right? The commentary is like you'll see a little bit of price increases continue in 26. That feels, normal for the business. Transaction activity is where things have been weaker. So I think Depot has taken the stance, as is the case with a lot of other retailers. We've passed on a bit of price. We'll deal with it selling a little bit less units. And hopefully you see sort of a recovery in engagement in some of these project activity over time. But you'll still see some modest price increases in the business this year. You
mentioned that transaction volume. It was down, 1.6%, I think, in the quarter, but average ticket was up. So, that's an interesting story there, right? That fewer people were going in or spending, fewer transactions, but spending more and buying bigger things. So what does that tell us?
Yeah, there's some aspect with storms, right? You had a lot of hurricanes in 24 that you didn't have in 25. So you had some lower transaction activity, just less people kind of coming into the stores. So we'll see how that reverses over the course of 2026. One of the important points in the guidance for 26 is second half of the year should probably be better than the first half of the year because we'll have a easier compare from a storm perspective. But, Julie, it's been the trend. We've seen less traffic into some of these stores because you have a homeowner that probably is in their house that's doing projects, right? But you don't have that sort of, buying and selling activity that spurs, larger project activity. So you just have less people kind of visiting the box.
So when you look at the company's guidance for the year and recognizing that you're saying the second half should be better, the company missed last year. So what needs to go right for them to achieve their guidance for this year?
Yeah, it's interesting. The last couple of years, we've seen them reduce guidance in the middle of the year. Last year it was later because they kind of talked about the fact that the lack of hurricanes had a worse impact on the business. The 2 prior years was kind of in the middle of the year. I think it feels like it's the housing market, right? I think the commentary has been, we've been basically stable. The homeowner that has the home is kind of engaged in some projects, but you really need to see that existing home sales kind of pick up to see some of the larger project activity. We also cover, Lowe's. We cover Floor & Decor, right? Floor & Decor is a retailer that's very much tied to large project activity. And it's kind of challenging out there. So you're still kind of bouncing along the bottom. We'd love to see things turn, but housing is different than apparel and retail, right? Like that can turn much quicker. And when you think about housing, it's very slow in terms of how things inflect.
Just one last quick question on Home Depot. Of course, they've been making some acquisitions on the pro side. How's that integration been going? And has that been successful in offsetting some of the weakness we've seen?
Yeah, that's the big story with Depot, right? Is like you're in this environment where we can debate the housing market, and it's kind of been bouncing along the bottom. But I think they're really positioning to go after more of this large pro, and they've done some acquisitions that have given them much bigger foothold. At SRS saw some challenges because of the lack of storms, right? So the roofing industry, they gave a data point on the call that roofing shipments in the industry were down 28% year on year, one specific SKU, whereas the SRS business, I think, was down only low single digits in the fourth quarter. So they were actually very encouraged with that, and it was up low singles for the year. So I think the message is they're gaining share. 26 is probably a better year because hopefully, the you've got this easy compare from not having storms. You have a normal year and sort of weather activity that should be a positive. But I think the big message on Depot is, we're investing to go after that large pro. We want to gain all of their sort of wallet for building materials. They had some nice announcements earlier in the year about, using AI to kind of plan projects. I'm sure there's more of that to come for purchasing materials. So I think the big getting bigger is definitely a theme when you think about some of the changes, and Depot being a strong operator, they're probably going to compete very effectively in this space.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. Hello and welcome to Market Domination Overtime. Stocks closing higher here following a sharp sell-off on Monday. Let's kick it over to Yahoo Finance's Jared Glickry with the very latest. Jared.
Thank you, Josh. Best day for the major indices since February 6th. That would be 2 weeks. Let's take a look at the intraday price action on the Dow, up 370 points, 0.75%. Nasdaq, a little bit more. Retail and tech came back strongly today, so that index up about 1%. S&P 500 about the same as the Dow. They're very similar looking charts. Also throw in the Russell 2000, 1.2%, and again, a very similar chart there. So let's take a look at the large cap sector action, how we rounded out the day. Consumer discretionary was pretty much the leader all day long. Second place, we had tech, then industrials and utilities, also up more than 1%. And by the way, we got 2 record highs from staples and utilities. Those have been very well-performing sectors all year long, but that's also kind of defensive, so take that with a grain of salt. To the downside, we had energy and healthcare slightly in the red. And let's take a look at the Nasdaq 100. A lot of green today, so this is a big departure from yesterday, and we got some nice outsized performance from Intel and also AMD. Intel up almost 6%, AMD almost 9%. In fact, check out the semiconductors heat map here. We got a couple red squares, but for the most part, seeing a lot of green and a little bit of dark green there. By the way, the Philly chip index hit a record high as well. And even software, which a lot of days this year has just been a sea of red, even if the rest of the market was green, well, we got a lot of dark green here too. So Take Two up over 4%, Thomson Reuters up 11%, Zscaler up 4%, and also Salesforce up 4%. Let's head over to the Dow, and we can see not a lot of red. United Health down 3%, but JP Morgan, McDonald's, American Express down just marginally. Covered Salesforce, but also seeing above 1%. We got Caterpillar, Home Depot, IBM bouncing back from the worst day since 2000 yesterday. Boeing, Disney, and Goldman Sachs, each of those up more than 1%. And I'll leave us off on transportation because this has been a storied sector this year. Kind of boring, but not a few weeks ago. And this has been bouncing back nicely as well, except for Expeditors down here. That's one of those logistics companies that got kind of trounced last week or 2 weeks ago. Nevertheless, airlines snapping back. We got United up 5%, Delta Airlines after up 3.5%, and that's after fewer flight cancellations than we were looking at yesterday and over the weekend.
All right, Jared, thank you. And diving deep now into crypto and more, our very own Inez Ferre. Inez.
Yeah, Josh, just taking a look at the crypto heat map on Yahoo Finance, you can take a look at Bitcoin. It's hovering just above 64,000 per token. You've also got Ether that's down or about 0.4%, also around 1,800 per token. I do want to point out what's happening with Bitcoin, and that is that it's been suffering its worst month since 2022, since the crypto winter, because of risk-off sentiment, ETF outflows, and also bearish positioning. Year to date, you're looking at Bitcoin that is down about year to date, about more than 20% down year to date. Josh?
All right. Thank you, Inez. Well, volatility reigning supreme in the market with investors proceeding with caution. Here for a look at where retail traders land in this market turbulence. Let's get to Tom Sosnoff. He is founder of Lost Dog and former Tasty Trade CEO. Tom, it is great to see you. So maybe start off with trade and tariffs, Tom, because the Supreme Court, they weigh in, they strike down those Trump IEEPA tariffs. But Trump, you saw, he's defiant as ever, Tom. So investors are trying to think through this. What does it mean for the economy, Tom? What does it mean for markets? You say, though, speaking as the trader that you are, you say here you don't pay attention to all this tariff talk. How come, Tom? Walk me through it.
Well, as a trader, if you start paying attention to tariff talk and macro talk, you're going to end up paying attention to things that really have nothing to do with whether the fact you make winning trades or losing trades. So I think that part of the fun part about being an investor, whether it's retail, professional, whatever, is that you kind of get to fade the news a little bit. You get to be a little bit of a contrarian, and you kind of try to outguess what's happening next. And I think that's the fun part. So I think the more you pay attention to the macro scene, the more difficult it is to actually be a trader.
So let's talk about those retail investors, Tom, because you always have good line of sight there. What are they doing right now, Tom? Are they hunkering down? Are they buying? If they are buying, what are they buying? Where do you see the activity?
Well, I mean, activity-wise, today I would say that, just looking at the volumes, it was massive volume in Intel because, in Nvidia, because everybody's playing it for, tomorrow afternoon's earnings and things like that. I think that's where, if you're just looking for the action, or at least, the most amount of contracts, that would all be in Nvidia. But if you're thinking about where is retail? Retail is surprisingly, retail's become very good and very sophisticated over the last, let's call it 5-7 years. And I see retail also playing the contrarian game. We saw a lot of buying this morning in stocks that had gotten beaten up. I'll give you an example, like Robinhood, for example, would be a stock that we saw retail kind of nibbling on the corners. A lot of quantum stocks this morning, retail nibbling, just nibbling. And just like the last host, a lot of action today, just buying around the edges in different digital assets. We saw Bitcoin buyers, ETH buyers, people stepping into Solana. I mean, these prices are down, 50% from actually not too long ago, just a couple of months. So it's just interesting how people are looking for things that they perceive to be cheap. And you can argue stocks like PayPal and Netflix and things that just have been kind of bottom fishing and that kind of stuff. I mean, that would be my argument. Things that are just kind of on their butts.
What do you make, Tom, of the great AI trade? And specifically, I'm curious to get your thoughts on how AI has just taken this sledgehammer to certain sectors, certain verticals. You can look at the software space, Tom, the IGV, it's been clobbered. I'm just curious, long-time market watcher as you are, what do you make of that? Does it look fair to you? Do you say this is crazy? There's opportunity here? What do you think?
Well, I think there's no question there's opportunity. Has the sledgehammer, has it been a little bit too much? I would, it's hard to say because I'm somebody that's been kind of in the trenches for so long. I look at this rally in the tech stocks, which is now going on almost, just under 2 decades. And I start to think, well, this sell-off in the software stocks has been absolutely brutal. But in reality, it's probably long overdue. I think it's on a short-term basis, it's probably exaggerated. I don't see them going back to anywhere close to old highs, but I do think like yesterday, in the case of IBM or something, I think that was way overdone. With respect to the AI stocks, which was the second part of your question, I think they're fully priced. I think they're a little scary to me. Like, I'm sure Nvidia is going to have good numbers. The question is, are they going to be good enough to hold this price level? But when you start to look at different stocks like Micron and Nvidia, and you start to think about, these stocks they're flirting with all-time highs, and we're only a couple of percent away from all-time highs now. You're starting to think that the AI stocks may be full. I think at least they're fully priced.
Well, one narrative, Tom, it's interesting, is there was this storyline out there that the big AI names, they had to hold in there. They have to hold in. If they fall apart, the market falls apart. But what's interesting is, this year you've seen people, they've been finding new trades, new opportunities. You look at the sectors that are leading this year, energy, materials. What do you make of that?
Well, we've both been doing this a long time. And part of it's just part of the story. Part of it's just creating a narrative where you have to create a little fear to get excitement and to create opportunity. So I think part of it is just the narrative of thinking, oh man, have we gone too far? I think the other side to this is if you've been doing this for a long time, as long as we've been doing this, and I think a lot of people like us, you realize there's always opportunity. And the story that it's a little bit, the story's always a little bit cyclical, and you just kind of hope that, that you catch the right part of that, of that sector rotation. You can do this for the next 10, 20, 30 years, and you're always going to have one sector rotation after another.
Finally, Tom, got to ask you about this, my friend. You were a co-founder, of course, of Thinkorswim and Tasty Trade. Now you're launching Lost Dog. So I was reading through this, Tom. All right, so it sounds like an AI tool where, in simple terms, Tom, is this going to, one, it sounds like it's going to tell me, am I being paid what I'm worth? And two, do I have the right portfolio in place to grow my wealth? Am I reading this right?
Well, I've spent the last almost 4 decades building, software for individual traders and retail investors. And I wanted to do something in the area of like fairness, portfolio fairness and worker fairness. So we built a platform that we're just about to roll out, which is focused on optimizing your career worth and your portfolio worth using a combination of software tools and AI tools. And it's actually really cool because it's tied to trading. It looks like a trading platform. It smells like a trading platform. It walks like a trading platform, but there's no trading on it. So it's actually a platform that's designed to tell you, hey, you know what? Most executives in this world now are overpaid, and most workers are underpaid. And the gap is not contracting at all. It's widening. And the reason it's widening is because we just don't really understand why that is. And so what we're trying to do is to provide like numbers, quantitative numbers, statistics around, why am I underpaid by a couple of $1 million over my lifetime? And I think that through education, we can close the gap in worker fairness and close the gap in worker inequity, and also help people optimize the way they look at their portfolios. That's one of the beauties of AI, is it can be used to enhance and optimize consumer returns.
Tom, as always, so good to have you on the show, my friend. Thank you.
Thanks for having me. Love it.
Well, check out shares of PayPal here, spiking late in the trading day. Bloomberg now reporting the company could be a takeover target by Stripe. The privately held fintech company has expressed early interest in acquiring all or parts of PayPal, and the deal may not happen, but worth noting, as Stripe, the 5th most valuable private company according to Yahoo Finance data. PayPal, we know, is facing slowing growth and mounting competition, and the company just announced a leadership change earlier this month. A tie-up would combine a fast-growing infrastructure player with one of the industry's original pioneers. Neither Stripe nor PayPal commented to Bloomberg in that report. Well, coming up, we look at how President Trump's State of the Union could address affordability concerns. That's next on Market Domination Overtime. President Trump giving his State of the Union address Tuesday night, and the economy will be, of course, front and center for both investors and consumers. Joining me now, we got Caleb Silver, Investopedia editor-in-chief and the pride of Colgate University, on set. Caleb, let's start here. So I'm interested to get your take, how you think Trump sort of frames the economy, frames these issues of affordability and economic anxiety, because I think its instinct is he wants to say, this is the greatest economy ever. It's never been better. If you've got these affordability worries, it's your problem, not the economy. But would that be the smart way? I'm thinking, no, maybe the smarter way is to say, listen, I inherited all these issues. I got all these problems. I'm fixing it. It's getting better. You got to stick with me.
Well, he'll say a little bit of both. He'll definitely blame the past administration for inheriting the economy. He said that he's fixing. He'll also call it the greatest economy in the world, the best the world has ever seen, and it's only going to get better. The problem is the headline numbers may say one thing, the real feel on Main Street tells you a completely different story. And that word affordability, the Investopedia term of the year for 2025, by the way, because people were constantly searching for the fact that things just aren't affordable no matter what I keep seeing in the headlines. CPI, inflation might be coming down a little bit, home prices might have leveled a little bit, but in general, week in, week out, The grocery basket's getting more expensive. You're paying more for health insurance. You're paying more for health care. You're paying more every time you get on a plane. Have you noticed that? Plane trips that used to cost $380 now or $460, $480 maybe. Maybe you check your bag if you're allowed to. Maybe you get to pick a seat, bring your own nuts. So the affordability thing is the issue number one. He won't be tender around it.
But couldn't he? Here's what I find interesting about affordability, and you're bringing up all very good points, as you always do. There's also positives. This is what I find interesting, in that he could say on there, and he would be right to say, listen, broadly, GDP. I mean, last time I checked Atlanta Fed GDP tracker, he had like a 3 handle on it. He could say gas prices, Caleb, Josh, when you're going to fill, price at the pump, it's like $3 is the average. The 30-year fixed. The 30-year fixed, he could say. I think it was closer to maybe a 7 when he took office. You're back down to like a 6 handle, according to Mortgage News Daily. Doesn't that all sound pretty good?
Yeah, but he has nothing to do with the 30-year fixed. And in terms of gas prices, that's about supply and demand. And we produce plenty of gas in this country. When you see low gas prices, that's a sign that we're just not buying as much and demand isn't that strong among businesses and industrial manufacturers and people that use a lot of it. That said, there are some positives that he could point to, absolutely. The stock market maybe being one of them, even though presidents have nothing to do with it, but policies do help, and the stock market dancing around record highs. It helps people that have investments in the stock market. That's about half the country. And also asset prices. If you think about home prices, those have been pretty high too. So if you own assets, you're doing fantastic. If you stayed invested, you're doing fantastic. The headline numbers like GDP, when was the last time you talked to anybody out there in the real world about how's your GDP doing? Most people will tell you my GDP is not great. Guess what? I had to take on another job because I can't afford all the things that I used to be able to afford with this one paycheck. So it is becoming more of a crisis for some people, especially those who have a lot of debt. Credit card delinquencies, we know, are nearing all-time highs again. Not a very good sign. And people's concerns about their personal economy are not great.
I thought there was a very interesting piece in Vox, okay? And they were sort of digging into this very issue. Why do folks feel so bad about a pretty decent economy under Trump, which was their words. I think that's exactly a pretty decent, which I thought was notable. It's not like, listen, you're not going to like bang up. Vox is not a right-leaning place, okay? Pretty decent economy. And they, in that piece, they focused on, and they talked a lot about what we're talking about here. And the reporter focused on, you know what? A big thing, utility bills. Utility bills, if you know, people were unhappy with the cost of living to begin with, and now they see these utility bills. That, they think, goes a long way to explaining why people don't feel so great.
Because that is a need, not a want, right? If the wants people are okay with, hey, it's a little bit more to fly on vacation, take the family on vacation, maybe we won't. But when you have to, it's the things you have to pay in on a week in, week out basis, that makes you feel like things are just getting more unaffordable, and that's how most Americans feel. Top 10%, doing fantastic. Ask Amex, go to the front of any airplane. It's stuffed right now in first class. The wealthy are doing great because they own assets and they are invested in the stock market. Everybody else is literally trying to get by on what they used to make, even though wages are up, 3.7% on an annual basis, a little higher than inflation. It's just not keeping up with things like utility bills, like health insurance premiums, like the price of beef, like the price of coffee, and tariffs have not helped that equation. So you can't say we're making things more affordable on one hand and then say, but we're adding another 15% of tariffs on the things you buy on a weekly basis on the other. You can't say it, he will.
Let me ask you, we're so focused on what Trump says today about the economy. Is it even fair to credit or blame a president for all these things we're talking about? Or would you say, listen, it doesn't matter. In the words of Trump, it is what it is. He's going to get the credit or the blame.
Yeah, and that's just the way it is. But when prices are high, when people feel like things are unaffordable, guess who they blame? The government and corporations. And if you hadn't noticed, Frito-Lay lowering its prices 15% across the board just a couple of weeks ago. That never happens. They're hearing it from their customers that, hey, these prices have gotten out of control. And whether that's tariff related or the fact that they just had price creep after they shrunk the packaging on things, they're actually lowering prices. I haven't seen a snack company do that as long as I've been covering the industry. So there's that going on the one hand. On the other hand, you have people who are worrying about the uncertainties that tariffs and our geopolitical policy present. And it seemed like that was at bay for a minute until last week, and now that's thrown in the air. As you know, kryptonite, uncertainty is kryptonite for investors. It's also kryptonite for small businesses that are trying to order into the fall and into next year.
Final question, those very smart readers of Investopedia What's on their wall of worry? When you ask them, what are you concerned about right now? What are they telling you?
Yeah, our most recent survey closed about a week and a half ago. It was geopolitical uncertainty because of the threats about Greenland, because of what had happened in Venezuela. If you looked at it today, it would be tariffs and then geopolitical uncertainty and then the threat of inflation again. So they're worried about prices. We also asked them this one question: what would you do with an extra 10 grand? Always they say, we'll buy individual stocks.
Yep.
Third on the list this time, pay down my debt.
Interesting. What do you make of that?
People are trying to brace themselves for an uncertain economic future, and that's because they just don't feel as secure as they maybe should be given the headline numbers.
Caleb, always good to see you, especially on set, my friend.
Thank you. Thanks for having me.
All right, time now for what to watch Wednesday, February 25th. A quick note ahead of tomorrow, President Trump delivering his State of the Union tonight. At 9 p.m. Eastern, investors will be listening closely for signals on trade and tariffs. On the earnings front, we're getting a check in on retail with TJX and Lowe's, as well as insight into the software sector with Salesforce and Snowflake. But all eyes, we know, they're all on Nvidia, reporting fourth quarter results on Wednesday in a pivotal moment for that AI trade. Chipmaker, one of the only mega cap names in positive territory this year, even as investors grow more skeptical about the pace of AI spending. Analysts are looking for roughly 68% revenue growth in Q4 with big focus on demand for its next generation Vera Rubin systems. In media space, Paramount Skydance is announcing fourth quarter results as it escalates its takeover fight for Warner Brothers Discovery, submitting a higher bid, potentially forcing Netflix to now respond. Investors will be watching how the M&A battle intersects with streaming profitability and price hikes. And finally, fresh commentary from Fed officials coming on Wednesday, including Richmond Fed President Tom Barkin. Yahoo Finance's very own Jennifer Schonberger will be interviewing Barkin on Wednesday at 3 p.m. Eastern. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned. Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving right into. Stocks staging a bit of a turnaround Tuesday. The Dow jumped more than 300 points on the day as the AI-fueled sell-off cooled off. We're watching the EV space as well. A busy day between Lucid earnings and Lamborghini giving up on its luxury EV dreams. We've got all those details. Plus, we're getting a read on the consumer through the lens of the wedding economy. We've got the trends to watch and how Gen Z is reshaping that ecosystem. Well, love may be priceless, but weddings certainly aren't. Couples spent more than $100 billion tying the knot in 2025, with the average price tag holding around $34,000. That's according to new data from the Knot, and how Gen Z is crashing the party using AI, shifting the diamond market, and reshaping consumer demand in a timeless industry. Join me now, we got Raina Moskowitz, CEO of the Knot, and Yahoo Finance senior reporter Brooke DePalma. Welcome to you both. Raina, I'll start with you. What interests me, Raina, is we hear a lot about the American consumer. They've got these questions about affordability, economic anxiety. But then I look at your data, weddings are holding in there. Per your data, the average wedding cost, it held steady at $34,000. So do you look at that data, Raina, and say, okay, actually Americans, they're actually financially healthy, they're resilient? Or do you look at that and say, they're stretching for this?
We look at the data, and weddings really are resilient. It is a big market, and what we see is that despite any sort of economic pressure or uncertainty, people continue to prioritize the big day. And so I wouldn't read it as a broader indicator. I'd read it as how important it is and how much people are craving connection and celebration right now. And so above all else, they continue to prioritize their budget for the big day, which has held steady year over year. In fact, increased very slightly to $34,000 on average. And that's a national average, of course. So we're seeing budgets hold, we're seeing guest counts hold steady, and we're seeing that couples are hiring on average 13 vendors to bring their big day to life. And so it's a very resilient category.
Let's talk about timing the wedding, because Josh, if you didn't realize, there's a peak season to weddings now, and so what can you tell us about timing your wedding, just in terms of what can you expect? What's the peak season, and also how much more would it cost to get married on maybe a Saturday versus a Sunday?
Yeah, so couples on average take 14 months to plan their big day, and we see trends. We see people planning really early. We see people planning near in, but on average, it's about 14 months, and so that's a huge amount of time. And so what we see is couples it really varies. And couples work with their vendors to figure out how to allocate and manage their budget in really smart ways. And so the earlier you plan, the better, the more flexibility you might have.
Negotiate a little bit?
Absolutely. And I think vendors are incredibly talented and creative. And it's important that couples want a really personalized experience. And so the more you can be upfront with your vendors about what matters to you, they can help partner with you to really meet your budget needs. And so, there is actually, people think that peak season is in the summer. It's actually in the fall. And it's very popular to get engaged over the holidays. And so December is really peak engagement season, Christmas Day being the biggest day, when friends and family are already together. And then people tend to get married in the fall. So, and you shared with me as well, sometimes when you're in wedding season, it feels like almost every weekend you might be going to a wedding. And so that's why couples really want to get creative with their dollars and how to create the most personalized and authentic experience to them.
Speaking of dollars, Rainey, here's another data point I thought was interesting. Spending per guest, you all say, it actually rose to $292 a head.
It did.
What explains that?
It did. So Gen Z in particular cares deeply about the guest experience. And so, as I said, right, you might be going to a wedding every weekend or once a month. And so how do you get your wedding to stand out? And so we see Gen Z in particular prioritizing the guest experience as the thing they care the most about. And so they want to invest in their guests who are taking the time. And again, it's about connection and celebration. And so we've seen the guest investment go up significantly over the past couple of years. And that really signals the priority of how they want the celebration to feel. And so, we're their partner along that journey to make sure that we are bringing all the creative elements together and helping them create the big day.
Now, part of that survey even said that before couples are even getting engaged, they're doing a ton of research before. I was a bit skeptical. I was nervous. I was like, should I be looking this up? But what can you share about that? Is that the right thing to do, to maybe plan ahead before you even pop the question?
So in addition to the category being incredibly resilient overall, I am very excited about the trends we're seeing from Gen Z. So about 41% of people planning a wedding right now are Gen Z. And yes, we are seeing Gen Z taking action even earlier. They're looking at inspiration on social. They're even reaching out to venues and vendors. And so people are ready. And I'm very, again, optimistic about the trends that we're seeing in the category overall. Gen Z really taking an interest and wanting to get married. And in fact, we see that Gen Z has even larger weddings on average. And we also see that parents of Gen Z tend to contribute a bit more towards the wedding, so that might play a role, given they're a little bit
I wanted to ask you that, Raina.
earlier.
Who is paying for all this? Is it like the couple or mom and dad are chipping in?
On average, we see about 50-50. With the parents chipping in and the couple. And again, that probably depends on your age when you're getting married. And so we see Gen Z with parents leaning in even a bit more. And again, that's because they're still on the younger side. The overall average is about 32 to 33 years old.
And in terms of what exactly people are prioritizing, it seems like the concept of content creators are sort of overtaking videographers. Have you heard that same trend?
We've seen the trend, and I've spoken to photographers, videographers, content creators. We have relationships across the board, and I would say it's in addition to. So people tend to prioritize, photography and often videography. So it's not a trade-off necessarily, but yes, people do care about how their photos show up on social. And so there is a new category emerging of content creators that couples do prioritize. But I would say it's typically not an either or, it's in addition to.
Same price tag though.
I think there's a wide range. And so what we do on our platform is we make sure that we understand a couple's style, budget, where they want to allocate their dollars to help you find the vendors that meet your needs. And so again, I think it really comes down to the couple and what they value and how they want to prioritize. But with over 900,000 vendors on our platform globally, over 200,000 in the US, we've got a wide range for all budgets.
Raina, Brooke, so good to have both of you on the set today. Thank you.
Thank you so much.
Thank you.
Stick around. Much more Ask for a Trend still to come. Let's dive into the electric vehicle space now with a look at Lucid, that EV maker reporting its fourth quarter results, and Yahoo Finance's Praz Subramanian joins us here with more. All right, Praz, so Lucid reports. You spoke to the CFO. What'd you learn?
Well, we're talking about here, look, the theme right now, I think the stock is down because of the fact wider losses than expected, right? We're seeing, down 5-6% here, adjusted EBITDA loss of $874 million in Q4. I mean, that's just a pretty insane amount. So I spoke to the CFO about, are we expected to see these losses persist going into next year or going to this year? And he said, no, we've done a lot of production ramp for the Gravity SUV. As that vehicle ramps up, he told me most of the production in Q4 was that car, and that car is supposed to be, widely selling automobile, being an SUV. So as those sales ramp up, it'll cut into the sort of the per car fixed costs. That'll come down. They have a mid-size SUV, mid-size vehicle coming out in 2027. That'll also help bring down those costs. But I asked him, are you guys going to do another capital raise? And he said, look, we're good till the first half of 2027, but we do anticipate potentially needing more, and we'll be judicious about it and see opportunities where we can make some cash come back in terms of capital raises. But look, their largest shareholder is the Saudi Arabian PIF, private investment fund, public investment fund, and they have nearly $1 trillion in assets. So I think they're okay if they need more money, but it's just the fact that just so many losses is a problem.
Sticking with that EV theme, Lamborghini, when you wrote about this, pulling the plug on its upcoming luxury EV. What's the story there? Yeah,
they were one of the first luxury supercar makers to say, hey, we're going to do EV. Back in 2023 at Pebble Beach, they debuted the world premiere of the Lanzador EV. I actually got to drive this thing as a prototype. It was really cool to drive a car. Usually you don't let you do that, but they were so high on it. And it was cutting edge design, really cool interior. They thought this is the future. And it turns out, we spoke to, the CEO Stefan Winkelmann a while back and other people there saying, what's the demand like? Are people asking for it? It's like, well, they want its electrification. They want to be green, but they still want emotion. They still want excitement. And now he said in an interview at the Sunday Times that the demand was close to zero for the vehicle, but it's just that they just didn't have the emotion that they want. Emotion being sound, vibration, just sort of like that experience of being in a car, an analog experience, right? EVs don't provide that. So that's what we're seeing with that car. The demand was so bad that they thought that, we want to do electrification. We need to because of rules in places like Europe and things like that. We're going to do plug-in hybrids. We're going to do things like that. So gas remains, but you're going to have hybridization.
What do you make then, though, Praz? So Lamborghini makes this decision, but Ferrari's still going ahead with its EV.
Yeah.
So what do you make of that? Who's making the smarter bet?
Ferrari, they also put a lot of money into this investment. They're trying to see it through, and they claim that they have made some sort of inroads into making these EVs more engaging, exciting, emotional in a lot of ways. If you look at Rolls-Royce, okay, that's a different example. Those buyers want quiet waftability. They want immediate, smooth power. That's where EVs work. And the Spectre EV for Rolls-Royce has been, I think, their second top-selling vehicle. It works for that application. I asked, you're kind of asking the right question. Will it work for Ferrari or Lamborghini, where part of the emotional engagement with the car is why you buy the car? And I think that's the issue. Well, Ferrari...
Sound is important.
Sound is
critical. Sound's experience.
Yes, the vibrations.
100%.
The smell of the gas, right? That's part of it. So the thing is, has Ferrari solved it? We will find out in May when they reveal their new EV.
Finally, you wrote about this. This is interesting. Tesla registrations in Europe, fell 17% in January. That was, you point out here, Praz, that was the 13th straight month of declines. Overall registrations, they rose nearly 14%. So then do you look at that, Praz, and say, this is a Tesla-specific problem? This is an early sign of, EV saturation? What did you think when you saw that?
Well, you see that EV sales are still rising in January, and they rose last year in Europe too. Clearly there's demand there. The question is, why isn't there demand for Tesla? Are the cars too expensive? Is it the Elon factor? Are there maybe the new vehicles? I think all three of those factors are part of the equation as to why Tesla's struggling in Europe. We can't discount the Elon factor, right? That's part of it. But on the flip side, BYD, right? Sales surging, tripling almost.
165%? Yeah.
And they're offering not just EVs, but also hybrids. And I think Europeans are seeing it's dollars and cents or euros, right?
Do you, when you see that number though, BYD, that is a remarkable surge. Do you think that's price, that's tech, that's product mix, all three? What is that?
I think it's all. I think it's mostly price.
Yeah.
They're just undercutting European makers, Tesla, whoever else, other automakers. So price is huge. It's hybrids too. A lot of those are hybrids, right? So that's going to be a cheaper car in general, and it's easier to have that kind of car as your only car, for instance. So I think it's a combination of all these. I think price is a big factor. Look, in the United States, what happens when the question is it not if not when, right? For the Chinese automakers, when they come here, what happens? Are Americans going to say, you know what, I want to support my American automakers. I love my big three. I don't want to support Chinese automakers. Or they're saying the price is half as much for the same for a car that's built better tech. Who knows? That's the problem that you're seeing for Tesla in Europe, and I think other European automakers too.
All right, Praz, thank you. Appreciate it.
Thank you.
Stick around. Much more As for a Trend. That's still to come. Stocks reverse course on Tuesday as worries over AI disruptions ease. Yahoo Finance's Jared Blickery joining now with the trade day takeaways. Jared.
Thank you, Josh. We got to talk about the risk on day that we had. It was nice to see. Long ways from being out of the woods in certain sectors, but I want to highlight something here. Here's the S&P 500. I'm going to show you, let's put this on a 6 or 3 months we'll do here. So this goes back to late last year. That's a lot of chop right there. In fact, the record high was somewhere in here in January. We are only 1.7% off from record highs. And yet some days it feels like the sky is falling down. That's mainly a software story, and we'll get to that in a minute. But the main point is, I was reading it earlier today, Ned Davis research says 60% of stocks this year are outperforming the S&P 500. That is a huge amount. So it tells you that this index is just being kind of dragged down by either some really large names or just by one segment. And I think that's software, because the large names, the Mag 7, really haven't done that badly, although they haven't been a boon at the way they have in the past either. So suffice to say, this is a rally that if you get software going again, well, it could be finally we could be talking about some new record highs.
What about software? Do you look at software and say, you know what? The worst is over. The bottom's in. Let's call it.
That's a great question, and that's my question too. The point is, bottoming is a process. So we might have to wait a little bit. Let me show you what happened today, and then we're going to compare that to what's happened over time. And software, a lot of these companies peaked in September of October last year. So this has been going on for a while, even though it seems like a lot of the headlines are fresh. But we got that new AI report over the weekend that just kind of decimated things. So here's what happened today. We got a lot of nice green here. Thomson Reuters up 11% after getting smashed a few weeks ago. But here's what's happened in the month of February. And you can see almost everything down, except for the top row, down double digits. And the worst here, a lot of these names off 25, 40% in the case of Atlassian. And then you go to year to date, and the picture actually worsens because Unity is down 58%. So there is a long way to go for a lot of these names to recover that. But the question is, are we bottoming? I'm just going to repeat it. It's a process, and you don't know when the bottom is in. But a lot of times you just have to wait until everybody is fatigued. Nobody wants to touch software again. And I think we got just a few too many people saying, well, I kind of like software at these prices. Might need another washout. Could be wrong there, but I think price action is going to tell us we just had a fresh drop in IGV to new lows yesterday. And so I don't think we're out of the woods just yet. If we had a huge rally and it looked like a false breakdown, that would be another story. But I think we'll get a few more clues this week, and we'll just watch the price action and let us tell it.
You want to talk crypto?
Let's do that. Because Bitcoin was also leaking lower today. In fact, the whole crypto complex was, but it wasn't a big one. And this is par for the course, because on a day when we had equities and kind of just a general risk-on flavor, Bitcoin and the crypto world was largely not participating here. So I'm going to show you the standard chart. Let's go to 6 months. And this is going to give us the record high, and here we are near the bottom. And I'm going to zoom in here. Let's do a 2-month chart. And so we kind of got stable here, but it's not good when an index just goes slightly down like that. It doesn't look like it has much force, because that means it's probably not going to have much resistance going through that lower support price. So I'm not confident that the bottom is in just yet. A lot of people talking about 50,000 or the 40,000s, but I'm going to go back to this chart, which I showed a couple weeks ago. And here we go. So this is Bitcoin performance past versus current. So the blue line is what's happening now. This is 2023 to 2026. That's 4 years, and this would be the end of the year over here on the right. And we have no idea where this finishes. Here's where we are right now. So this is actually about 2 weeks old, but the price has gone nowhere. Then we have 2019 to 2022, and you can see it's following a very similar pattern. This is what we call an analog. And what happened then, and I'm just going to remind people that Bitcoin, it didn't bottom right away. In fact, it just kept kind of tricking people, and it kept sucking new longs in. And then finally, when everybody was exhausted, and this gets back to the bottoming as a process, when everyone is exhausted, that's when you see that's the time to buy. And so I'm not sure we're right there yet.
Finally, want to end on gold?
Yeah, let's do a little bit of that, because gold and silver have been perking up. They're not gangbusters rallying like they were a few months ago. Let's see, GC equals F. No, that's not going to be it there. Let's just do silver, because that picked up today as well. That's up 0.75%, and we'll do the year to date, and there we go. So this has been, silver been trading in a range right here. It's trying to break out of that. That's a positive development. It's not doing that with a lot of momentum, but what you need is a catalyst. And there's a lot going on geopolitically and everything else wise where we could get that catalyst. I don't know, it's going to be State of the Union. Gold is a little bit different, but it looks like we're out of time. So gold's heading higher as well.
Stay tuned for tomorrow. Thank you, Jared.
Thank you.
Appreciate it. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.